and welcome to Fidelity Connects. I'm Pamela Ritchie. Trump's tariff threat and a strong US dollar have been putting pressure on emerging markets. While China's economic activity did accelerate more than expected in the final 3 months of 2024, was this a short-lived theme? And within which regions across the globe does our next guest see value over the next few months? Earlier, institutional portfolio manager Abhijeet Singh joined me to discuss the investment themes shaping Fidelity Emerging Markets Fund. Take a listen. Hi, Abhi. Great to see you.
Good to be here.
Great to have you join us. And we are absolutely going to be digging into the themes and how the positioning ultimately of the fund, how you invest. But I would just love to take this moment to ask you to respond or give some thoughts on how the new Trump administration is making comments, making all kinds of headlines about many countries that are within the remit of the emerging markets mandate, if that's okay.
Yeah.
Okay. Well,
definitely. Yeah, I think you can go around the globe.
We'll go around the globe
about
a little
different
bit.
Countries.
Perfect.
How they're reacting to the news, the real steps, or at least the news that's kind of moving relatively quickly, I would say, in the last few days.
Do you mind if I jump in and talk about India? I'll just ask, India has created a policy kind of in advance of receiving major tariff discussions to repatriate Indians back to India who do not have the proper papers to be in the United States. And they've just sort of gone ahead and done that in advance. It's one example of a response, isn't it, to this new administration?
Oh, yeah, that's definitely one of the major points of conversation that happened during the election in the U.S. and the countries, as they think about their position going forward in terms of negotiations, avoiding tariffs or what have you, are playing their cards differently. So everybody's kind of moving slightly different direction. India is kind of taking a little bit more, I would say, moving a little bit more quickly and trying to be in a better position to kind of have a conversation, negotiation. Mexico has been going back and forth in terms of how cooperative they want to be. And I think the story has changed a little bit, I would say, in the last, again, couple of months. And probably will change over time as we go forward. But I think it does come down to at least Sam and the team, and we think that tariffs are a point of negotiation. And if it's a negotiation, that means that you're not going to see a sudden change in policy. Rather, it'll be a negotiating tactic that leads to some sort of conclusion. And I think China is also in the same bucket. Is they're trying to figure out, how to react, right? So they did some stimulus towards the end of last year, which had like a big bounce in the market that was a response to it. But since then, haven't really done a whole lot. I think they're in a wait-and-see mode to see what the policies are and what kind of agreements they can get to before they respond with more robust stimulus to jumpstart the domestic economy.
So that's really interesting. Can I ask, is that across the board a bit of a wait-and-see of how you are managing the fund right now? Because you do have to wait for some of this to settle? Yeah,
I think so. I think the countries are doing that, and we are doing that as well. So It's very hard to predict where things are going to go. So the countries are kind of waiting and seeing. As you mentioned earlier, that the dollar is kind of been a little bit stronger. That's in the anticipation that the Federal Reserve might not cut as much. And that leads to emerging market countries not necessarily being able to cut rates either. And that's true for countries like India in particular. Indonesia has cut a little bit, but not a lot. Brazil and Mexico are in a slightly different bucket, but essentially everybody's still connected to what the Fed does in terms of their own policy, and that's going to play out over the next 6 months, I would think.
Do you think that, tell us a little bit more about the currency story. I mean, you need a country, I guess, if you're going to invest in a company within it, for the currency to hold on some level. I mean, how do you do that right now? It seems incredibly difficult at this moment.
Yeah, I think you have to have certain base cases in your assumptions around individual countries and their currencies relative to US dollar. And our view is the dollar has been in this strong pattern for a very long time. You might see volatility or movement, in one direction or the other based on, again, headlines, which I don't recommend people reacting to it on a daily basis, and we don't do that either. But net, you think, where the economy is. If you start seeing a little bit of a slowdown in the U.S. economy, not talking about a collapse, just a slight slowdown that leads to the Fed, cutting rates to support the economy, that'll be a great place to be as an EM investor, an EM country, because then, all that pressure on currencies goes away. And as that happens, then you can stimulate your economy and kind of jumpstart economic activity even further. And I think that's still the base case. But as I said, it's a little bit more wait and see than anything else. The Fed is doing the same thing. We're not seeing the Fed kind of projections about the number of rate cuts, etc. It's kind of muted, right? Nobody's talking about it. And that tells you that maybe we have rates higher for longer during this period of uncertainty of policy, or we might, again, depending on as the clarity comes to the market, you might see the market Fed move and currencies move accordingly.
Do you think? I guess it's going around the world to different countries that probably will have some version of a trade discussion, whether it's tariffs or it's a trade war, whatever it is. If there's a deal to be crafted, which you're suggesting that the tariff discussion ultimately is to get to a deal of some sort.
And I think everything kind of falls in that bucket.
Everything does. Okay, so do you need to be invested before the deal's inked, I guess is the question.
Oh, that's my personal opinion. Yes, you can't time these things. You can't time, currencies. You can't time different markets. You can't time different asset class components. So you want to be positioned in such a way that you benefit from any type of inflection point that happens from a policy perspective, but then also all these like trade conversations as they get resolved or move in a certain direction. You want to be pre-positioned. So EM, in terms of an asset class, I think it's in a very good place in the sense that there are a lot of things that can jumpstart the net flows into emerging market equities and also economic activity at the emerging market level. So net, you want to be positioned in advance. We are overweight places like Brazil and Mexico in the portfolio, overweight China. We are underweight India. We've been that way for the last several quarters, and that's kind of playing out over time. So our positioning is pretty set coming into this year. We're going to let it ride in terms of like how things develop based on that positioning, and then react to any type of news that comes out of different conversations, and adjust the portfolio as needed. So that's where we are today.
The way that
we'll see how
it plays out. You are GARP investors. You're not looking at the most expensive, overvalued, which most good investors are not. But if you want to just take us there, because India has been, the discussion of Indian equities have been that they're overvalued and have been for some time.
Correct. Yeah, I mean, India is a classic example that if you look at just the fundamentals of the economy over the next decade, 2 decades, looks very attractive. Everything is great. They got to put in a lot of infrastructure in place. They're finding ways to attract manufacturing. They still have a very low cost labor available for manufacturing and things like that. So there's a very good long-term story, and they have political stability to a certain extent as well. All that is positive, but the markets have really gone up a lot. So the valuations, the multiples that you're paying for Indian equities are sky high, even though they have come down a little bit towards the ground, I would say, in the last couple of quarters, but not enough in terms of balancing out. So net in the near term, we are underweight, but that doesn't mean we're not positive on India's prospects long term. So it's more about, as you mentioned, growth, but also what you're paying for the companies matters to our approach.
Tell us about are you thematically invested at this point? That seems like an old EM discussion, but take us there. What are the types of companies that you're finding as opportunities in various countries?
So in India, which is where we're underweight, but there are still pockets of areas where we think there's an opportunity. So one of the things that we've adjusted in the portfolio over the last, say, 6 months or so is becoming a little bit less exposed to AI-related names. AI has been very hot. Stocks like TSMC have gone through the roof in terms of their size in the emerging market benchmark and in general performance. So we have been going a little bit in the other direction in terms of becoming a little bit more underweight that particular name and that category of stocks as well. And in India, we've been basically looking for places like IT services companies. Now that's a space that's been out of favor, but it does benefit from US dollar strength, because that's where a lot of their earnings are coming, and also their valuation is relatively reasonable in the India context. And if you believe that the AI infrastructure story is great, it's been playing out. A lot of people are putting billions of dollars into the infrastructure. At some point, there's going to be a desire to have an ROE on return on investment, rather ROI on these investments, and they're going to lead to coming up with new applications, software solutions, integrating AI into different systems and all that. So these companies are actually positioned quite well to benefit from that leg of development when it comes to all the AI spend that we've seen over the last few years.
That's so interesting. In terms of India having very high valuations, there's many reasons for that. But one of the pieces of the story was actually cheap oil from Russia for a while. Is that about to be interrupted or changed, or to what extent will that continue to be useful?
That's a great point, because that's something that we've heard some news on recently around essentially the desire to bring the war to a close.
Yes.
So while on one side you could see more stronger enforcement on how the Russian oil can get into the world market, that could lead to higher prices in India, could lead to inflation, and really keep their central bank from cutting rates. On the other side, if you see a peace deal or some sort of a ceasefire, then all of a sudden that goes in the other direction. So there is, again, that's another one of those wait and see, not sure which way it'll end up, but it could be an interesting dynamic, because one of the things that we are also exposed a lot in the portfolio to is Eastern Europe. We're talking about Hungary, we're talking about Greece, Poland. These are, and more recently a position in Turkey as well. These are companies and ideas that they have a great story standalone in terms of where they are, what the fundamentals are, but they could be very interesting plays if you do see a movement in the direction of a halt in hostilities, right? So there's going to be a huge rebuild. A lot of infrastructure has been destroyed in a number of places in the Middle East as well as in Eastern Europe. So there are companies, financing companies, banks, and other things that are in that region that could benefit from that as well. So there is, again, we're pre-positioned. Yeah. We do support those stories on where things are today. But there could be a kicker behind those stories if you do start seeing like a resolution or some sort of an agreement. So that'll be another one of those you can add to that list of wait and see.
Yeah, okay. Well, we've got more to go. We're not finished with those. But let me ask you about the Middle East. Similar situation. It looks like a peace is being hammered out finally. But more broadly, just from sort of your investment perspective, I mean, the deals are coming fast and furious from the investments. Commitments to invest from Middle Eastern leaders, companies, and so on. Is it an area that you're investing in?
So we have been cautious in Middle East, mostly because of valuations. So if you recall, a few years ago when the war started in Eastern Europe, a lot of the Russian equities obviously were exited from the benchmark, and you were not allowed to invest in it. And the investors essentially exited that part of the market. And they all went into Middle East. So the valuations in Middle East are very high. We have one position in Middle East that's a gas drilling play out of UAE. But in general, valuations are quite high. Things that you like from a fundamental basis that are not necessarily tied to the governments in Saudi Arabia, whether it's a private bank or a hospital network and things like that. Everybody's already out there. So again, the question of balancing growth with what you're paying for that, it kind of keeps us away from it. So, but it is an area that's going to continue to see a lot of investment. As we all know, Saudi Arabia has a vision to kind of diversify away from energy sector and build, kind of really open up the economy, build tourist destinations and things like that, which will, if they come to fruition, it will be very interesting and does create a lot of demand for all types of construction and equipment and services and so on. But that's some of that is still quite far away in terms of in the future, and we'll kind of invest in things that will benefit from that. Some of that could be like Larsen and Toubro, a company based out of India that's an engineering and construction company. Nearly 20-30% of their business is in Middle East, and they're benefiting from those types of investments. So we're looking at all the different plays that might play out in that space.
That's fascinating. You mentioned China before. We mentioned China off the top, talking about a bit of growth that we saw, or not as bad of a growth picture actually at the end of 2024 as perhaps had been expected. And there was, as you said, wasn't quite their version of the bazooka, but it was a bit of a whatever it takes promise on stimulus. Still haven't seen that actually. I mean, not proper massive stimulus. Can you please explain to us where it appears the Trump administration sits vis-a-vis China? Because TikTok seems to be okay, and we thought maybe it wouldn't be. And it's really interesting to try and divine how the administration is thinking about trade with China. I mean, is it dire or is it actually not so bad? What do you think?
Again, time will tell, but the President Trump has had a conversation with President Xi on the phone, and they've talked about certain pockets of conversation, TikTok being one of them, but then also fentanyl and how to get the Russian-Ukraine war to a close, and a few topics that they want to make progress on. So I would think it'll be a give and take in different situations, but that there is definite, I would say, seeds in place for some sort of an agreement to get to where you don't need to have an outright trade war, and that's where again time will tell. But there is, as you said, the TikTok situation is kind of, again, there's a law in the books in the U.S. that they have to do something about it. They've got a reprieve for like 75 days, but that doesn't mean after 75 days, you can just keep going on because it is a law in the books. The Supreme Court has said that it has to be implemented and so on. So there's a limited time of opportunity, which actually is good because that means you have a deadline. So hopefully we'll get resolution to all these different topics that I talked about in one chunk. Hopefully, so that's again wait and see.
Wait and see. But if I go back to what you said, almost off the top, overweight to China, underweight to India, overweight to Mexico, and I think you said Brazil. Let's just talk about waiting and seeing, but there's sort of a Girl Guide phrase in there, like be prepared too. Like you need to be in it before whatever. So what about now? I mean, I know it's wait and see, but you're speaking to Canadian investors who actually are seeing our own currency have a bit of an anchor on it being pulled down. So it's interesting to look at how other currencies, countries, companies might react and when to get in, essentially.
Yeah, I mean that's a $1 million question.
I know,
but I would say have a strategic allocation to different asset classes and kind of stick with it, because what you're paying for a lot of these innovative companies in China in particular is at an all-time low. What the valuation of these companies are right now compared to their history, compared to the rest of their peers around the world, you are seeing a real opportunity to get in, which basically means it's a coiled, it's like a depressed spring essentially, and it can come back to life with very limited, limited push. That could be in the form of some sort of a trade agreement. That could be in the form of some sort of a ceasefire in one place or the other. That could be in the form of, again, central bank policy pivots and so on. So there are a lot of things that can push these companies in a positive direction from a re-rating perspective. Earnings are actually not too bad coming out of these companies now. So it's only a matter of time where the market starts valuing it. And then if you see a little bit more flatlining on returns in the US, then investors are going to look for places where they can find more higher returns. So that could also be like something that could come into conversation. Doesn't mean the US market goes down, but it probably just means that it doesn't go up like it has over the last couple of years.
So interesting. It's so interesting to look outside of North America actually right now, because it's we're feeling a bit concentrated there. You mentioned Brazil, you mentioned Mexico before. Let's talk about the Americas broadly. Let's go to South America. It's been interesting watching the Argentine president know a little bit that his country is in play and playing a bit to China in terms of investors and playing a bit to the US in terms of investment and investors. What for South America, again, with the new Trump administration, I mean, what do you think some of the designs are there?
Yeah, I think like in Mexico situation is obviously tied into the immigration discussion, so it's a little bit different, and obviously trade is being used as a leverage to kind of reach some sort of a agreement in that space. So it's a little different. I think net U.S. needs Mexico, and Mexico needs U.S. Same is true for Canada. So there will be what do you call a mutual understanding on different topics that are of concern between the parties. But I would say if you go down further in South America, Brazil is kind of a unique situation in the sense they were cutting rates and then they started raising rates because inflation kind of picked up a little bit. They will eventually, get the peak and go in the other direction. That should be net positive for equities at that point. We think the valuations in Brazil look pretty attractive. Mexico valuations look attractive because Mexico reacted to its own election and then to U.S. election, and the devaluation of peso, etc., has led to like a pretty sizable downward draft for like the valuations there. So that looks attractive as well. Argentina is not really in our universe in terms of emerging market index, but there are. I wouldn't be surprised that at some point in the next a few years that we might be looking for opportunities to invest there. Still early days in terms of becoming a more reliable destination for institutional investors. So time will tell how that moves, how that plays out over time. But early indications are they're making a lot of radical changes on the economy, and they're seeing some benefit from that. So the next question is like, how do you generate employment? How do you generate investments? And to your point, that's why the president is, trying to look for a deal with the U.S., but then also trying to attract, more trade with China.
Yeah, it's really, really interesting just to sort of see how this ultimately will land. Tell us about the consumer in different countries that you're mentioning here. There's much discussion about the U.S. consumer, the health of the U.S. consumer broadly. You mentioned a number of the companies that you're looking at are obviously making money. You wouldn't be investing in them if they're not. But to what extent are they exposed to the consumer and the stories there?
A lot of our exposure in China and Chinese equities is around the consumer. It's around the area that is most depressed in China is like consumer sentiment, consumer spending on big ticket items. Some of the travel stocks have moved, but some of the white goods stocks are really in a holding pattern, whether it's EV companies or even like in that supply chain, or you're looking at even the consumer goods companies. They are all have reached the bottom, but not necessarily seen the uptick in economic activity that they need. So consumer spending there will be a big tailwind for us, and we are exposed, I would say, like to a number of companies that will benefit from that, and then also some of the tech companies in China that are again Tencent and Meituan and other places, PDD. These are all companies that are very attractively valued, and again that turn in sentiment is going to be the fuel that's going to propel them very quickly. We saw a little taste of that at the end of
September
last year.
That was wild.
And you saw
it just shot.
Companies moving up 40% very quickly. So you could see a more sustained version of that if things kind of fall in place.
So we hear a lot about sort of the bearish case for China. There's a couple of different angles to look at the bearish case for China. Real estate is obviously a concern. But there's a lot of this discussion of the Japanification of China. To what extent does that hold for you?
To a small extent, in the sense it's not the same, right? So one of the things that is different today versus, say, 30 years ago, 40 years ago, is like there's a lot more technology in place to replace or augment workers in terms of automation, robotics, AI, all these things kind of push in the other direction of a demographic trend. So the demographics of China are weak. They are getting old. They're getting old really quickly. But at the same time, you have all this technology that's being developed globally as well as within China that's going to help them mitigate the negative effects of that over time. They're trying to change some of their policy around, one-child policy has been repealed and other things. That's very hard to kind of change that culturally, and they're realizing that it's not easy to kind of people to start. It's not a switch that you change a culture to go from like a very strict one-child policy to like have as many kids as you want. But at the same time, the robotics and the technology development and other things are going to help mitigate those concerns about falling into doldrums and having a tough time getting out of it. Having said that, China has been going through kind of a deflationary cycle, which is very different from the rest of the world, and they're exporting a lot of that to different parts of the world in terms of cheap goods or very competitively priced EVs with good quality products as well. So it's kind of a mixed bag. So I think their story has been mostly focused on exports, but they have to figure out the consumption side of story as well. So because if there are tariffs or if there are any pushback on exporting these low price goods, it has to be replaced by domestic consumption, and that could be an interesting trade-off. And I feel at least that's what will drive the next leg of stimulus, is like when they have to replace exports with domestic consumption.
That's so fascinating, because we haven't actually seen that quite yet. Okay, as a final thought, you've mentioned, we're talking a lot about tariffs. We're going to continue to hear a lot about tariffs and so on. But TINA, which is there is no alternative to U.S. equities, basically is what it's meant. That's now. Tell us, what we need to be thinking about a couple months down the road. I don't know how far down the road. You'll tell us.
Well, the one fact remains is that U.S. is kind of the engine of innovation around the world. So we do have these, not just the Mag 7, but also like, a big chunk of the tech space is driving innovation that's going to have an impact around the world. The whole world needs that. And so that attractiveness is going to be there. But what has not been there is the rest of the sectors have not necessarily participated in this upside over the last 2 years. So the US market could have another leg up, but maybe not led by the ones that have been leading over the last 2 years. But
so
it could,
interesting.
Could see a good year, in spite of the valuations and how things have gone up in certain parts.
We'll leave it there. Abhijeet Singh, Institutional Portfolio Manager for the Emerging Markets Fund at Fidelity. Delighted to have time to hear your thoughts. It's such a critical moment for the global story. Thank you.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed, their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again, and see you next time.